Overview. A Random Walk Down Wall Street by Burton G. Malkiel was first published in 1973 and as of 2015 is in its 11th edition. Despite numerous market shifts and technological developments since 1973, Malkiel asserts that the investment strategy laid out in the first edition of the book holds true. The best way to earn money in the stock market is to buy and hold a diversified and balanced portfolio of index funds. Index funds are mutual funds that match a certain market index, such as the S&P 500. No other technique has proved more effective over time. The book is written with the investor rather than the speculator in mind. An investor is someone who wants a steady monetary return on portfolio, whereas a speculator plays the market much like a gambler and seeks quick-hit profits. The term random walk relates to the fact that past events cannot determine future outcomes. For example, no matter how many times a coin is flipped, whether it lands on heads or tails has nothing to do with the results of previous tosses. From the view of an investor, this means that short-run gains and losses in the stock market are unpredictable. This theory runs counter to the beliefs of Wall Street professionals whose work presupposes it is possible to beat average returns through predictions. In general, financial professionals work from two methodologies. The majority follow what is referred to as the firm foundation theory, which posits that each stock has an intrinsic value based on measurable factors. Stocks fluctuate either above or below this value, and deciding whether to make a purchase is a matter of timing. Another handful of professionals follow what is considered the castles-in-the-air theory, which posits that stock prices are driven by human perception of their worth, and the movements of stocks can be charted to reveal patterns. Aside from mega-investor Warren Buffett and an exceedingly small percentage of fund managers, no one has really been able to make long-term gains by utilizing the principles of firm foundation. This is due to many variables, including random events, inflated reported earnings, errors by analysts, and conflicts of interest. Using the castles-in-the-air approach, an investor might make short-term gains and benefit from buying trends, as happened during the Internet bubble, but overall it is not a viable strategy. Unless an investor has inside information, such trading is simply a gamble. Based on the consistent performance of the stock market over time, the efficient market hypothesis is the most reliable market theory. This hypothesis proposes that a stock will always trade at fair value, which is based on all the current available information. Because prices are set by market efficiency, which is impossible to predict on a consistent basis, any gains made by following a set theory are essentially based on luck. Although the major crashes in the market in 1987 and 2007 seem to disprove this, supporters of the theory point out that these wild declines were necessary corrections and thus ultimately support the concept of efficient markets. To devise a portfolio, investors should take stock of their financial position, including factors such as age, financial goals, tax status, and tolerance for risk. A younger person with a longer investment horizon will generally tolerate more risk than someone about to retire. Risk can be hedged by other investments that will go up if the risky stock goes down. A good portfolio will include a fair representation of stocks across the S&P. It will also include some international and emerging market funds, as well as commercial real estate funds. It is generally wise to hold on to stocks rather than selling when stocks go down and returning when prices rise. It is also beneficial to add bonds to a portfolio because these generally increase in value when stocks decrease in value. Despite the hype around hedge funds and portfolio managers, the best way to make money off the market is to invest in non-managed index funds and hold them for at least a decade. Sensible investors can take control of their financial future and make smart and profitable choices without having to rely on the expertise of Wall Street gurus. Key insights. 1. The firm foundation theory posits that every stock has an intrinsic value which can be determined by measurable factors. 2. The castles-in-the-air theory was made popular by legendary economist John Maynard Keynes, who believed stock prices were driven by people's perceptions of their value. 3. A follow-the-herd mentality leads to buying frenzies and stock market bubbles. It is best not to invest money into these frenzies. 4. Technical analysis refers to the method used by proponents of the castles-in-the-air theory to determine a stock's value. It generally involves producing charts to determine patterns that show when to buy or sell. 5. Fundamental analysis is the way those who believe in the firm foundation theory determine a stock's value. Analysts look at expected growth rate, expected dividend payout, degree of risk, and the level of market interest rates. 6. Fundamental and technical analysis can be combined, and stocks can be bought on 3 guiding principles. Buy stocks with high expected growth rates, never pay more for a stock than its estimated fundamental value, and buy stocks that have a buzzworthy appeal to the general public. 7. Neither technical nor fundamental analysis has proven to be a consistent method to earn profits on the stock market. 8. The technical analyst's strategy of buying in and out of the market and keeping cash positions can lead to missing out. 9. The risk of a stock is determined by its volatility, which is referred to as systematic risk. 10. The efficient market hypothesis posits that stocks will always sell at their correctly valued price based on the information available. 11. Over the long term, it is still more profitable to buy a diversified portfolio of index funds and hold it than to invest in managed mutual funds or short-term trades. Important people. Burton G. Malkiel is an economist and best-selling author who has worked both in the investment business and academia. He was chairman of the Vanguard Group for 28 years. He is now a professor of economics at Princeton University. He is known for being a strong proponent of the efficient market hypothesis. John Maynard Keynes, 1883 to 1946, was a British economist whose influence has changed the theory of macroeconomics and directed the economic strategies of many governments. Along with his many important economic insights, he posited that stock prices were primarily based on the buyer's perceptions of value rather than the actual value of the stock. Robert Shiller is an academic, Nobel laureate, economist, and author. He's currently a professor at Yale University. He's written many books, including Irrational Exuberance, 2000. Eugene Fama is an American economist and a professor at the University of Chicago. He's famous for his work on portfolio theory and asset pricing. In 2013, he was awarded the Nobel Memorial Prize in Economic Sciences, along with Robert Shiller and Lars Peter Hansen. Author's style. Malkiel writes in a clear conversational style. The book is full of humorous asides as Malkiel pokes fun at the idiosyncrasies of Wall Street. He does his best to explain much of Wall Street's opaque terminology in a layperson's terms. He explains the current theories driving the market. He first defines them, then disassembles them, and shows their flaws. He includes many charts and graphs and a few equations. Along with an index, the book has several appendices that delve into complicated topics like financial options and derivatives. It provides a list of suggested mutual funds and exchange-traded funds, or ETFs. Author's perspective. In this 11th edition, Malkiel explains that he remains as convinced as he was 40 years ago that his theory of investing is correct. He believes that the majority of managed funds cannot beat the market long term. He asserts that investors should buy and hold a solid and diversified portfolio of index funds. He points to the many grateful letters he's received from homespun investors as proof of his methodology. Intended audience. Although Malkiel asserts a random walk down Wall Street is meant for the layperson, it is helpful to have at least some basic knowledge of finance, such as the difference between stocks and bonds, before reading this book. An ideal reader of this book is someone who may have such basic knowledge but wants to improve his or her investing strategy. It is also an important read for students of finance who want to understand counter-arguments to widely accepted theories about the market.